The broadcast is now starting. All attendees are in listen-only mode.
Hello and welcome to NOVA's presentation of 401k Loan and Distribution Basics with Melissa Kaywood and Stephanie Reep. Before we get started, I'd like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions and chat. This is where you will enter in any questions that you may have for Melissa and Stephanie. Please keep in mind that the Q&A portion of this webinar will be held at the end, and they will answer as many questions as time permits. If time does run out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions and chat, you will see the handouts dropdown. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end to fill out our pop-out survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirement. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce from Nova's distribution team, head reviewer and trainer, Melissa Kaywood, and our team leader, Stephanie Reep.
Hello, everyone. Welcome to our webinar on distribution and loan basics. If you want to move to the next slide, Melissa. Got just a couple of housekeeping items here. First is just this disclaimer. This information that we're giving you is meant to be general in nature, and it's not intended to be a substitute for legal or tax advice. So we do encourage you to consult a qualified professional, such as an attorney or accountant, if you do need legal or tax advice. And then the other thing too is if you're looking for CPA credit, this does qualify. Our provider number is there on the screen. We just ask that you are present for the entire webinar and return the evaluation form that we'll be sending after the webinar. So if you return that, then you should receive your certification within a week for the CPA credit. So our agenda today is going to be distribution and loan basics. I'll start going through the distribution basics. I'll discuss distribution types and some taxation issues related to distributions. And then I'm going to turn over to Melissa, and she's going to go over loan basics, and she's also going to discuss vesting, some of the common problems we encounter when processing distributions and loans. And she's also going to go through some of our cybersecurity policies. After the webinar, we hope that you will understand the mandatory and optional distribution options that are in 401k plans. We also hope that you'll be able to identify loan provisions and loan requirements, and also just understand generally how vesting works for loan and distributions. So I'm going to go ahead and dive into the distribution basics. Just kind of something to keep in mind as you're going through this webinar is that there are a lot of rules and regulations that govern the funds in a retirement plan, both how and when they can be deposited into the plan and also when they can be removed from the plan. I've listed some common distribution scenarios that we run into when processing distributions. First one, most common of all, is the termination of employment or retirement distributions. Also, InService Distributions for participants that are age 59 and a half. We also see a lot of hardship distributions. We do see distributions for participants who have died or become disabled. And then we also see some distributions of rollover funds that participants have rolled into their accounts from prior 401k plans. So the first one here is termination of employment and retirement. And again, this is the most common one we process. So we do hundreds of these a week. Some key information for termination of employment distributions are that, first of all, this is a voluntary distribution, something the participant has requested because they've left employment. One of the things to keep in mind is that the funds cannot be paid out until the participant has actually had their termination date. So we will sometimes get requests from participants that are terminating in the next week or two, and they're going ahead and trying to put the requests in to get paid out, those requests can't be processed until they've actually reached their termination date. And then the other thing to keep in mind is that for participants that have recently terminated, there's often a final 401k contribution that needs to be deposited to the plan for their final paycheck. And sometimes they don't receive this for a couple of weeks after they terminate employment. So we do encourage plan sponsors, if they know there's going to be a final contribution, that they not approve a participant's distribution request until that final contribution has been deposited. And the reason for that is that oftentimes these amounts are small amounts, and if a participant takes their distribution before this final payroll contribution is deposited, they won't make the effort to request a distribution of the final payroll contribution. Most record keepers do require that participants make a second distribution request for this final payroll contribution amount. A lot of participants don't realize it's there, or they don't bother because it's a small amount. So to avoid problems with that, we do encourage employers, to wait until that final payroll contribution has been deposited to approve a distribution. Another kind of subset of termination distributions are involuntary force-out distributions. And these are distributions that the participant does not request, the employer requests them. And you basically are forcing participants with small account balances out of the plan. And the reason why you want to do this is that there's an issue with retirement plans in general where participants, especially participants with small account balances, will tend to get lost. They'll move and they won't change their addresses. Sometimes they pass away. There are a lot of different reasons why a participant may become lost. And so then the retirement plan now has all of these like small account balances in the plan and no way to contact the participants. So in order to avoid this problem, we encourage our plans to have these force-out provisions where these small account balances are removed from the plan, whether or not the participants are requesting a distribution. This can be set at either a $1,000 or a $5,000 limit, and I'll kind of go into the differences of that on the next few slides here. So again, these involuntary force-outs are employer initiated, so participants have not made a distribution election. The vested account balance has to be under $5,000. You can also set a $1,000 threshold. And when you have rollover funds from a prior employer in the participant's account, when you're calculating that threshold, you can either include or exclude those. So for example, if a participant has $3,000 in their 401k account and a $3,000 rollover from a prior employer, you can disregard that $3,000 rollover, which makes the participant's account under $5,000 and then eligible to be forced out of the plan. So the reason why you might see a force out threshold of $1,000 is because if it's under $1,000, you can actually force out the participant by a check. So the participant receives a check for 80% of their balance. Federal withholding is taken from the check, 20% of the balance and sent to the IRS for the participant's taxes. And the participant also, if they're under age 59 and a half, they're usually going to have a 10% early withdrawal penalty. The issue with these, though, is that sometimes you're trading one problem for another. So instead of having small account balances in the plan, now you've got uncashed checks in the plan because, interestingly enough, a lot of participants don't cash these checks when you send them out. Either they don't open them or, they just never get around to cashing them. I mean, it could be for any number of reasons, but it's really common for them not to cash checks. So what you can do is you can actually go ahead and roll these over to IRAs. And that's what we encourage our plan sponsors to do, is to roll these to IRAs instead of sending cash distributions to participants, because then you get it completely out of the plan and you're not running into that uncashed check issue. You can also set your involuntary force out limit at $5,000. And one of the things to keep in mind here is that if you do that, anything over $1,000, so anything from $1,000 to $5,000 does have to be sent to an IRA for the participant. Those amounts cannot be cashed out as a check to the participant. So, and we help our clients with this, but essentially participants are notified that they have this account. They're given a time period to respond. If they don't respond, then the funds are moved into an IRA in the participant's name, and the participant will have access to that IRA and can request a distribution from the IRA at any time. But it gets the funds out of the plan. And just for simplicity's sake and to simplify administration for the client, we encourage our clients to set their involuntary force-out thresholds at $5,000, and just to have all of them go to rollover IRAs and not have any checks sent out. We do an annual project for our clients to help them clean their plans out. I think we're gearing up to do our annual project for 2023 soon here, so some of you will probably be getting notifications about these. And sometimes we work with the record keepers also. They'll have their own kind of cash out projects as well. So sometimes clients will work directly with the record keepers. But if you have any questions about cash out provisions for your plan or cash outs in general, please feel free to reach out to distribution team. We have our email right there on the screen. You can also reach out to your account manager at Nova, and they can also help you, kind of understand your plan's cash out provisions and the process for cashing out the participants. In addition to the termination distributions, there are also a variety of distributions that can be processed while a participant is still employed. First one here is the age 59 and a half in-service distribution. The magic for age 59 and a half is that this is the age the IRS has said that participants are eligible to take their 401k contributions out of the plan if they're still employed. So that's why you'll usually see this in-service distribution provision set at age 59 and a half, because that's when the 401k contributions become available for active participants. This is an optional plan provision. Not all plans have it, but it is really common to see an age 59 and a half in-service distribution provision in a plan. Again, this allows employees that are still employed to take a distribution from the plan so they don't have to terminate or retire to get access to their funds. You can restrict what sources are available. Your plan document will tell you what sources are available. And one of the more common ways this is set up is that employers will allow you to take your 401k contributions, but they might not let you take the employer money until you've actually terminated or retired. Since participants are age 59 and a half, they don't have the early withdrawal penalty. And the other thing to keep in mind is that even though there's no early withdrawal penalty, if a participant takes a cash distribution, it will be subject to income taxes. Another type of in-service distribution that's really common are hardship distributions. We process quite a lot of these. Again, this is an optional provision, but it's very common in 401k plans. But this does give participants access to their accounts in case they have an emergency. Sometimes hardship provisions will allow participants to have the employer contributions as well. And one thing to keep in mind is that, again, these are going to be subject to federal income tax. They're cash distributions, so they will be taxable income to the participant. And often they're going to be subject to the 10% early withdrawal tax, because most of the participants are going to be under 59 and a half if they request a hardship distribution. Something to keep in mind about hardship distributions is that there is documentation that's required. In some cases, we may need substantiating documents such as invoices, receipts, copies of eviction notices, that type of thing. And then all hardships are going to require participants to sign some kind of hardship certification. So the reasons why you're allowed to take a hardship, the safe harbor reasons here are listed on the screen. And these are safe harbor reasons because these are reasons the IRS has said, these situations definitely qualify for hardships. And so that's why there are these safe harbor reasons, and we encourage our plan sponsors to have safe harbor hardships in their plan document. It also takes out any kind of guessing or discretion on the part of the plan sponsor. Participants just have to have one of these particular situations in order to be eligible. First one here is the purchase of your primary residence. Something to keep in mind here is that this is for costs for the purchase of the primary residence. So your closing costs, your down payment, that type of thing, mortgage payments, are not counted. It has to be purchase costs. The other one that we see too frequently, unfortunately, is to prevent foreclosure or eviction from the participant's primary residence. We do also see a lot of hardships for unreimbursed medical expenses, which are medical expenses that aren't covered by the participant's insurance, post-secondary education, so college expenses, casualty losses, which are deductible on the participant's tax return to the participant's primary residence. And these are typically going to be things like a fire or flood or storm damage, those types of situations. Burial expenses for the participant and their dependents, their spouse, can be covered. Also, there is a provision for hardships incurred as the result of a federally declared disaster area. So, for example, if there's a hurricane, the hurricane area may be declared a federal disaster area, which frees up hardship funds for participants as well. There have been some changes in recent years to hardships that make them a little more easier to administer, easier for participants as well. The first set of changes, major changes, happened as of January 1st, 2019. These are a few years old now, but we still like to put them in the webinar just because some people are still not aware that these changes have happened. So the 2019 changes are that participants are no longer required to take a plan loan before being eligible for hardship withdrawal. So prior to 2019, if the plan had a loan provision, a participant would be required to take a loan before they could take a hardship. Another thing that went away is the investment earnings. So prior to 2019, participants were only allowed to take their 401k contributions, but now they can take the investment earnings. They can take their entire 401k accounts. The other thing that changed is that participants no longer need to stop contributing to the 401k plan for 6 months. If a participant takes a hardship, they can continue their contributions immediately. They don't need to pause them. And then 2019 also freed up some additional sources of money for hardship distributions. So participants can now take hardship distributions from safe harbor sources. Qualified non-elective and qualified matching contributions can also be made available. Again, this is a plan provision, so it just depends on whether the plan document allows it, but those are eligible sources now. And then the Secure 2.0 Act had some additional changes for hardship distributions that we've all been kind of excited about because they've made them just a little more easy and more efficient to process. And this is for plan years beginning after 12/29/2022. So if your plan has a calendar year, the 12/31 plan year, these are already available to you. If your plan has an off calendar year, like a July or September end dates, the new rules may apply later in the year. So it's going to kind of depend on your plan year end. But the major change here is that participants can do self-certification of hardship withdrawals. So instead of providing copies of statements and copies of eviction notices and things like that, participants can actually fill out a self-certification form certifying that they have this hardship, this is the amount they need, and that they will maintain the hardship documentation in their own files. So they no longer have to submit it to their employers and have their employers review it. The employer can rely on the self-certification that the participant signs. This has resulted in faster hardship processing for participants. There's less paperwork and red tape. There's less back and forth trying to get the proper documentation with the proper dates and so on. And sometimes it can be kind of a burden to go back and forth with the participant to get the proper documentation. So now you can rely on the self-certification instead, and the participant just has to maintain those documents in their own files. So this eases the administrative burden both for the plan sponsor and the participant. But one key thing to keep in mind is this does not change the safe harbor rules, in that you still have to have one of those safe harbor hardship reasons to get a hardship. So you still have to be facing eviction or purchasing a home or have medical expenses or one of the other reasons. Even though you don't have to submit the documents, you still have to have a hardship safe harbor hardship reason to get a hardship. Another common distribution that we process are distributions of rollover funds. So participants will occasionally roll funds over from a prior employer, and most retirement plans will make those available as an in-service distribution at any time. So participant rolls it over, and then 6 months, a year, 3 years from now, they can request a distribution just from that rollover source. And this is something that's going to be in the plan document. Most of our plan documents include it. But the benefit of this is it encourages participants to roll funds into your 401k plan. And, you know, this helps the plan because you're getting more assets into the plan. You're also getting more engagement from the participant. If they've rolled funds into the plan, they're more likely to make additional contributions into the plan. And they get to kind of keep all of their retirement savings in one spot. So it's really a benefit both for the plan and the participant to allow them to have the option to withdraw the rollover contributions. Something to keep in mind is that when and if they do withdraw them as cash distributions, they will be subject to income taxes and then a 10% penalty tax if the participant's under age 59 and a half when they take the distribution. We also process death distributions. So when a participant passes away, their beneficiaries are paid out their retirement account. And we ideally will pay this out according to the participant's beneficiary designation election. So we really encourage our plan sponsors to maintain a valid beneficiary election for all of their participants. That way the participant can decide how they want their funds paid when and if they pass away. One thing to keep in mind is that if a participant is married, then their spouse, per retirement plan law, must be the beneficiary unless the spouse consents to a different beneficiary in writing, and the spouse's election does have to be notarized if the participant designates someone other than their spouse. If there is no beneficiary designation on file, the plan document does state the order of distribution. Our plan documents state first the spouse. If there's no spouse, it would go to the children. If there are no children, it goes to the parents. If none of those relatives are existing after the participant passes away, then it would be paid to the participant's estate. But generally speaking, if a participant can have a beneficiary election on file, it just makes the process so much more smooth as far as processing the distribution goes. One thing to keep in mind is that when a beneficiary does submit a withdrawal request, they should include a death certificate with the distribution form. We also process a lot of required minimum distributions, and this is actually another of our annual distribution projects that's coming up here soon. And these are distributions that participants that are age 73 or older must take from the plan on an annual basis. One thing to keep in mind about these is if you do have a participant over age 73 who retires and wants to roll their funds to an IRA, they do have to have their RMD processed before the rollover can be processed, because the RMD is not eligible to be rolled over to an IRA. We get a lot of those types of requests, so it's just something important for the participant to keep in mind when they retire. But as far as who's required to take an RMD, so generally it's going to be participants age 73 and older. Terminated employees that are age 73 and older must take a distribution each year. Also, owners that are more than 5% owners, once they reach age 73, they have to take a distribution each year, even if they're still active owner employees. The one group of participants that can defer their RMDs are non-owner employees that are still working. So if I turn 73 and I'm still working for my employer, I do not have to take an RMD as long as I'm not an owner. I can actually put that off until I actually terminate or retire. And, you know, again, we do an annual RMD project for our clients. So we'll help our clients identify those participants and get those RMDs processed each year. Another type of distribution we process is a qualified domestic relations order, QDRO for short. This is usually a divorce distribution. So participant has gone through a divorce and their former spouse is now entitled to a portion of their account balance. The rules for these are pretty complicated, so I'm not going to go into that now, but the important thing to keep in mind is that it does require a court order signed by a judge. The court order has to have some specific language in it, assigning the benefit to the former spouse. And also, it's just good to keep in mind that these can take a lot of time to process. You know, the paperwork in the court orders sometimes don't have the right type of language, and sometimes it can take several weeks, or even in some cases months, to get everything properly documented so the funds can be released to the former spouse. Another question we do sometimes get occasionally is around spousal consent. You know, do we need spousal consent for distributions? And in most cases for a 401k plan, the answer is no. It's pretty rare nowadays to have a plan that requires spousal consent, a 401k plan. Generally, if a plan does have spousal consent, it's only going to be for distributions that are more than $5,000. And the types of plans that are subject to spousal consent are plans with old money purchase plan money. You don't see money purchase plan money in plans very often anymore. Most of that money has been paid out at this point, but there are some plans that do have old money purchase plan money in them. And in that case, it will have a spousal consent requirement. And then, of course, defined benefit plans, your traditional pension plan, those do require spousal consent. So when a participant takes a distribution from a plan or requests a distribution, they should be given a special tax notice. And this special tax notice is going to have a lot of information for the participant about the tax consequences of their distribution, how they can defer taxes on the distribution. It's something, kind of a model notice that we get from the IRS. Most of our record keepers, when they generate distribution forms or online distributions, will include a special tax notice. NOVA also has a copy of one if you should ever need a copy, but it's something that should be given to participants when they request distributions. And then as far as some taxation issues surrounding distributions, for cash distributions, it's important to remember that cash distributions are going to be taxable distributions to participants. If they're eligible to be rolled over, there's a 20% federal withholding that applies. So that's going to apply to termination distributions, to a lot of your in-service distributions. It's not going to apply to hardship or RMD distributions. Those participants can elect out of tax withholding for those distributions if they want. The downside of that is if they elect out of tax withholding, they'll have a bigger tax bill when they file their tax return for the year. So a lot of participants will go ahead and do tax withholding for those distributions. And then the other thing to keep in mind too is that if participants are under age 59 and a half, in most cases, there will be a 10% early withdrawal penalty for any cash distributions. If a participant rolls their funds over, they can defer taxation. They can roll it to an IRA or to a new employer's 401k plan. If they do that, they won't pay taxes at the time they take the distribution, but they will pay taxes eventually if they withdraw the funds from their IRA or their other 401k plan as a cash distribution. At that point, they would pay taxes on it. So they can just kind of so if they roll it over, they can kind of defer that taxation and put it off until a later time. It's important to keep in mind that rollovers are not allowed for hardships or RMDs. Those must be paid as cash distributions. And with that, I'm going to go ahead and turn it over to Melissa, and she's going to start on loan basics.
All right. Thank you, Stephanie. So we're going to switch gears here and talk about loans. Loans may or may not be in your plan currently. They are an optional plan provision. You can have them taken out, you can have them added in. They have some pros and cons to them, like anything else in life. So we'll talk about those now. One good thing is it allows the employees access to their 401k plan. That is going to help you get participation in your plan. One of the reasons people don't want to participate is because they're worried that their money is going to be tied up and they won't have access to it in case something bad should happen. This gives access to those funds in a way that is not taxable to the participant as long as it's paid back. And as the plan sponsor, you can put in some pretty restrictive provisions into your loan policy. So loans can be an administrative burden, but they're using restrictive provisions will help to prevent that. So it doesn't have to be like a free-for-all. We do recommend that you have all loans paid back through payroll deduction. That also helps to keep things nice and clean, and you won't have issues with getting those loan payments made. And then, like I said, it's a plan provision that's optional. So if you wanted to add this, you would need a plan amendment. If you wanted to take it out or make changes to provisions, you would have to talk to your account manager to see how we can get that plan amended for you. Okay, so the first thing that a participant wants to know when they know they can take a loan is how much can I take? So the maximum amount is going to be the same across the board in every plan because this is stipulated by the IRS. So the maximum amount is going to be 50% of the participant's vested account balance up to $50,000. And that $50,000 is going to be reduced by the highest outstanding loan balance for the participant during the last 12 months. So we'll do some examples later on about how to calculate the maximum amount available, but that is a statutory limit across the board. Different things, different provisions, you have some more flexibility with, like your minimum loan amounts. So NOVA does recommend that you set a minimum loan amount of $1,000. You could do it at $500 if you wanted, for example, but we like to let the participants actually start to build an account balance before they start taking the money out. You cannot do a minimum more than $1,000, but you could do it less than $1,000. We do recommend keeping it at that limit. You can also play with the number of loans you can allow participants to take at a time. We recommend only one loan outstanding at a time. That way it makes doing payroll a lot easier. And then generally, spousal consent wouldn't be needed for these, so that's not generally a concern. But some other provisions that will be in your plan loan policy is the interest rate. The IRS states that the interest rate has to be reasonable. They don't exactly define very specifically what reasonable is, but in the industry, pretty much across the board, using the current prime rate, plus 2% is a pretty standard interest rate. I know that is the default in NOVA documents. You could elect a different one if you wanted to do prime plus 1 as an example, but prime plus 2 is pretty much the standard across the board. And then the IRS states that the maximum length of time a loan can be outstanding is 5 years. They do make an exception for loans that are used to purchase the participant's primary residence. Those are called mortgage loans, and that would be in your loan policy, the length of time for that. The standard default for that is 20 years, but you could set something different if you wanted to in your loan policy. You could choose 10 years if you wanted to. You could choose 30 years. We just kind of ask you to think about your particular business, your industry. How likely is it that the participant is still going to be employed 20 years from now when that loan is due? In some industries, that's not a problem at all. And some employers have great tenure with their employees and 20 years is nothing. For others, 10 years might be more reasonable. But you have the flexibility as a plan sponsor for that. Again, loans should be paid through payroll deduction, but one thing we wanted to point out is that these are made on a post-tax basis. So the participant, let's say they have only employee deferrals in their account and they take a loan. When it is paid back, it's done through payroll. You're going to set up your payroll like normal, and at the end, you're going to add that loaner payment that comes out of their paycheck. So that's coming out on a post-tax basis. It's going back into the plan and that elective deferral source. So just keep that in mind, that it is something that, they kind of, those loaner payments are coming on after taxes, then it goes into a pre-tax. They're going to end up paying taxes again when they eventually take a distribution from the plan, if they take cash. Not to sway anybody against the idea of a loan, but it's just something that we want people to be aware of. And then the other thing that you need to know is that loans generally become due upon termination of employment. So the participant terminates, whatever outstanding balance is left, that's due and payable. If they do not pay it back, then the loan will be deemed a distribution and taxes will be paid on the outstanding loan balance. There are some situations where you can roll the loan over into a new plan, but that doesn't happen very often. Okay, so your plan, if it allows loans, will have a loan policy that will have all of these provisions very clearly defined and laid out. The number of loans, the exact interest rate, what sources can be taken from the loan, what documentation do we need, how long a loan can be paid back over if it's for purchase of a primary residence. All those kind of things will be clearly defined in your loan policy. And it is extremely important that we follow that. If we don't follow that for a particular loan, then that loan is a prohibited transaction within your plan. And that's a big deal because it immediately becomes a taxable distribution. And if it's caught, not just the outstanding balance is going to become taxable, but the entire loan, even the part that was paid back, the whole thing becomes taxable. It's going to be subject to early withdrawal penalties, and it is kind of a nightmare, as you can imagine. So we want to make sure that we follow that loan policy. Every single loan that is requested is reviewed at NOVA to make sure we're not breaking any of those rules. There are fees associated with taking a loan. There's going to be a loan initiation fee. NOVA does charge a fee to review any loan request. We make sure that it is within the terms of the plan, and we make sure that the participant gets the necessary documentation, the necessary paperwork, their promissory note, amortization schedule, all of that. Your record keeper or vendor is also going to request or have a loan initiation fee. And then there's usually annual or monthly maintenance fees. That is not something NOVA charges, but the record keepers, generally speaking, do charge to record keep those loans. The participants will bear the cost of any loan. That's not something that the plan sponsor pays. If you really wanted to, you could set up to where, as the plan sponsor, you paid the initiation fee, but there's no reason to do that if you don't want to. It's typically a participant fee that gets paid. It comes right out of their account in the plan. All right, so the next thing that the participant really wants to know is, how fast can I get my loan money? What I would tell you, if you have a participant coming up to you saying, hey, I want to take a loan, what do I do? If you know the answer to that question in advance, it's going to go much smoother and it'll be a faster process for the participant. So we recommend that you understand that process. Some record keepers do not allow paper forms, and the only option is for the participant to go online or to call the record keeper. Some of them don't have the online option available to them. So a paper form might be your best bet. And then if you have that form available to give to somebody, that definitely helps speed things up. We recommend, if possible, go online. Tell your participants to go online. Even if there's a choice between paper and online, go online. There's a couple of reasons for this. The first is that online requests cannot have a lot of the issues paper requests have. It can't be missing pages. We can't have trouble reading it. Faxes come through, or forms with handwriting come through that are very, very hard to read sometimes. And that slows us down. So online, none of those issues can even exist. Also, the loan is going to be fully completed when it comes through. On the paper form, sometimes people will miss things like, how long do you want to take the loan for? They'll accidentally skip that blank on the paper form and won't fill it in. That's going to cause a delay. Online, it won't let them click the submit button unless they have it fully completed. So the other reason why we really like the online option for participants is that it gives them an opportunity to model different loan scenarios. It's way easier than a participant sitting in your office going, well, how do I know what my loan repayments are going to be if I take it for 2.5 years? What about 4 years? What about this? What about that situation? Online, they have the ability with the record keepers to put in those different information pieces and see how it will affect their actual loan repayments. And then they can easily make the best decision that fits their life. The other option that will help them get the money faster is to request an ACH instead of a paper check. That seems like an obvious, but the paper check is the default on all of these. So sometimes people miss the fact that they can choose ACH. Definitely recommend that to your participants. Don't skip over that part. And then obviously the participants need to know that they need to allow sufficient time for the funds to arrive. It's not the same thing as a withdrawal from a checking account. There is a lot more paperwork and a lot more that needs to be reviewed before the loans can be issued by both your TPA and your record keeper. So just help set expectations for the participants, and that if they know they have an expense coming up and they're going to take a loan to pay for it, don't wait until the last minute. Go ahead and request that loan in advance. Okay, so I have a couple of quick examples, and let's just see if these people would be eligible for the loan. So participant A has a current vested account balance of $2,000. They want a loan for $1,000, and they want it to be paid back in 2 years. The first thing that I'm going to do is I'm going to look at the plan. Does the plan allow loans? In this case, the plan does allow loans. They allow one loan outstanding at a time with a minimum of $1,000. I know that the maximum loan is 50% of the account balance. So 50% of 2,000 is 1,000. Yes, I would definitely approve this loan. Our second example is a little bit different. This participant has a vested account balance of $2,000. But that includes a $400 loan. They want another loan of $1,000, and they're going to pay it back in 1 year. Can I approve this loan request? So first thing, does the plan allow loans? Yes. And then I got to look at the loan policy. How many loans at a time? Oh, this plan allows 2, so that's good. So I take 50% of the vested account balance, and I get $1,000, which does match the minimum loan amount set here in this example. The problem is that outstanding loan has to be accounted for. I have to subtract that out of what is available because part of that balance is tied up in the loan already. When I subtract it out, I'm only left with $600. So in this case, I cannot approve the loan. And that person would have to wait until they had a larger account balance before we could process something. These examples are pretty, small numbers, pretty easy, but it can get complicated. So if you ever have questions with not sure and you're not able to go to the record keeper for any reason, please feel free. This is something that NOVA would be able to help your participants with in figuring out their maximum loan amount. Our next example, the participant C, they're doing really good. They have a vested account balance of $100,000. They borrowed $30,000 in February, and they were on top of things. They got it fully repaid in April. In May, they turned around and want to make a new loan request. So let's look at the maximum they can get. Their 50% of their vested account balance is $50,000, which is the maximum, statutory maximum. So that's perfectly fine. But the problem is that we have to account for the highest loan balance in the last 12 months. Because just 3 months prior, they took a $30,000 loan, I have to subtract that out of the $50,000 statutory maximum. This person is only going to get a $20,000 loan. This situation can come back to haunt people because they take a loan and they realize, oh, man, I really should have taken it for the full amount. And so they think, let me just pay it back really fast and then I'll turn around and request $50,000. It doesn't work that way. So if you have a participant who is in a situation where they're thinking about paying back a very large loan amount like this, we highly recommend that you get with us or the record keeper, find out what their maximum loan amount will be if they pay the loan back before they go ahead and do it. Because it can, as you can imagine, can be quite a burden for somebody who can't even get a loan equal to the loan they just paid back. So it can really financially hurt people. We're happy to help people figure out those calculations before they make any decisions. Okay, let's see here. So one thing when you have loans, it is inevitable, it's going to happen, is a loan default. And we do want to avoid loan defaults at all times. So what are things you can do to help with that? For starters, this is why you only allow loans through payroll deduction. The participants, I know they always mean well, I know they'll always do their best, but if we rely on them to send in a check once a month to make their loan repayments, inevitably a payment is going to be missed. That's just how life is. With payroll deduction, it's set up automatically and it can't be missed. So that's why we recommend that. The other thing for you as a plan sponsor is to set up those loan repayments immediately in your payroll system. Look at the start date on the loan documents, have the loan repayments starting on that start date. The documents should match your payroll schedule. A tip is to enter the total goal amount, which is going to be the loan payment amount, times the number of payments. And then you know exactly how much would have to come out of the participant's account. Once that, or paychecks, once that amount has been satisfied, the loan repayments would stop, the loan would be paid off, and everything's good. Where people run into trouble is if the participant goes on a leave of absence for any reason. You need to make sure that your record keeper, and go ahead and let NOVA know as well about that leave of absence. With some record keepers, the systems, their loan systems are automatic. They have kind of things built into the system so that if so many loan repayments are missed, the loan is automatically defaulted. It's not a human doing it, it's just automatically taken care of behind the scenes. The record keeper would need to know to put a freeze on that loan if the person is on a leave of absence to prevent the system from automatically defaulting it. So always let people know, like, hey, they're going on a leave of absence, we'll get that loan frozen. When they come back, you'd let us know, hey, they're back, and then we would look at getting that loan back on track for you. Loan defaults can be very costly to the participants because the amount of the loan that's defaulted, that outstanding balance that didn't get paid back, that is going to become taxable to the participant. And if they're under the age 59 and a half, they're going to have to pay a 10% excise tax as well. So we don't want that to happen to anybody. If we can avoid it, we want to avoid it. Okay, let's just say you have a situation where you have a loan that has missed payments. What do we do? There's always a solution. We can always, if the loan hasn't been defaulted yet, we can fix it. If you notice that happens, let us know right away. We have a couple choices. The easiest choice is for the participant to make a lump sum payment that equals all of the missed loan repayments that's adjusted for interest. You make that one-time lump sum payment to the record keeper, and then you just keep following the amortization schedule as if nothing bad happens. That's the easiest option from a paperwork standpoint, but maybe not the easiest for the participant to afford, which is understandable. If they can't afford to do like a balloon payment like that, we can always re-amortize the loan. Let us know. We can get you a new amortization schedule. What we do is we'll keep the maturity date, that end date, the same, and we'll end up making all of the payments just a little bit bigger so that the missed repayments are kind of accounted for. And at the end of the loan, your balance is still at zero. So no big deal. There is a grace period for these that are built in. And it's kind of a mouthful, but basically you have until the end of the calendar quarter following the calendar quarter in which the first loan repayment was missed. So let's say a participant misses a loan payment in January. They're going to have until the end of June for them to either make that balloon payment or get the loan re-amortized, get it fixed up. It also means that somebody who missed a loan repayment at the end of March has the same length of time until the end of June. So everybody's going to have at least 3 months Some are going to have, closer to 6, just depending on when that first repayment was missed. But definitely, if you notice any issues with any of your loans, let us know right away. Okay, I'm going to switch gears a little bit and talk about vesting for a minute. When I was talking about the loans, I mentioned the vested account balance. Well, what is the vested account balance? So all vesting is the employee's ownership right to the benefits in the plan. It accrues over time based on a schedule that will be in your plan document. Employer money types are the ones that are going to be subject to vesting. Vesting is the way you earn those employer contributions. The employee contributions are already 100% vested because they're the employee's money. Those deferrals, Roth deferrals, any rollover contributions from a prior employer that moved into the plan, they don't have to earn that because it was already their money to begin with. But your employer match, employer profit sharing, things like that are going to be subject to the vesting where the participant has to earn it. There are some employer money types that are automatically 100% vested always, and those are listed there on the screen: Safe Harbor, QNEC, QMAC. That's just the way that those money types are. They don't earn those. They're automatically 100% vested. Your plan document will list your schedule, and there's many different types of schedules. You can have, a graded schedule where every year they earn a little bit bigger percentage. You can have a cliff schedule where it's 0, 0, 0, and then all of a sudden 100. You cannot take more than 6 years to fully vest, and some money types have different rules with them. But generally speaking, 6 years, and it's going to be for employer match and employer profit sharing. There's 2 different ways that you can do the method where basically you get vesting by getting years of service. Well, the definition of a year of service is what is important here. This screen is about the hours method. In order to get credit for a year of service, the participant would have to work a specific number of hours in that plan year. Generally, it's 1,000. You could set it for less than that, but it's 1,000 in every plan I've ever seen. The average full-time employee takes about 6 months to work 1,000 hours. Even a part-time person will hit 1,000 in 12 months. So we would keep track of the hours that they worked every single year, and it's based on their date of hire and the plan year. It's not based on when they became a participant in the plan or anything like that. If you have a participant that you don't track hours for, like let's say they're salaried and you're not sure exactly how many hours they've worked in any given year, we have the option of using what the IRS calls the equivalency method. Generally, that's defined as 190 hours per month that the participant worked. Again, if you do the math, 6 months, they hit 1 year of service if they're a full-time employee. The other way is the elapsed time method, and this one is basically the anniversary dates of their date of hire. So did you work 365 days? If so, you get 1 year of service. So it's a little bit simpler to track, and we don't have to reach out for hours or anything like that. It does not affect their vesting in any way. So just were they employed with you or not is all that really matters with that one. So again, I have a couple of quick examples here. This participant, they have 2 years of service and they have a 3-year cliff schedule. So it's listed there on the screen for you: 1 year 0, 2 years 0, all of a sudden at 3 years, fall off the cliff and they become 100% vested. So their account balance is there. They have deferrals, the 5,000, and match at 3,000. So the question is, how much would this person get if they were taking their distribution? We know deferrals are 100% vested. We know the match is going to be 0 because they were only there 2 years. So they're going to get their deferral balance only at 5,000. The 100% of that match source is going to be transferred to the forfeiture account. The participant did not earn that money. In our next example, we have a participant that has 4 years of service on a 5-year scale. So a 5-year graded scale is just 1 year is 20%, 2 years is 40, 3 years 60, and so on. So their account balances are there. They've got 2,000 in deferral, 1,000 in profit sharing, 1,000 in safe harbor match. So if they were to terminate, how much money would they get? So we know that the deferral and safe harbor contributions are automatically 100% vested. It's the profit sharing that they have to earn. They had 4 years of service on a 5-year graded schedule, so that's going to be 80% vested. They'll get all of their deferral and safe harbor, and they're only going to get 80% of the profit sharing. The other 20% of the profit sharing is going to go to the forfeiture accounts. So they'll get $3,800 in this example. Oh, okay, I just had to. There's many different schedules you can do. There's 4-year graded, 25, 50, 75, 100, 6-year graded. So you can do anything as long as you stay within the statutory limits that the IRS sets. Really fast, we wanted to talk about some of the most common problems that we see when we get participant requests in. If we're talking about just distributions in general, a lot of times the forms we get are not signed. If the participant didn't sign it, we cannot really do anything with it. It has to be kicked back and get signed before we can begin working on it. If the plan sponsor signature is missing, we will do a full review, and then we'll send it to the plan sponsor to have them sign. But afterwards, it's still going to need to be submitted to the record keeper for processing. So just kind of keep that in mind. If it comes to us fully signed, we will submit it directly to the record keeper on our client's behalf. They don't have to worry about that. And then date of termination. It seems like the vast majority of the termination requests we get are missing a termination date. One tip is that if you guys will put the termination date into the record keeper website as they come up for your plan participants, we always check there first before we reach out to our plan sponsors, and we'll go and grab that date off the site. If it's an online request that they've made, the record keeper will automatically populate it with the date in their system. So that will definitely help to speed up processing terminations. For loans, the most common thing that a participant misses is to include how long they want to take to pay the loan back. We don't want to just assume 5 years, especially if it's for a small loan. So we'll have to put those on hold and reach out. The second most common thing is the payroll frequency. So we're going to have an amortization schedule, and it should match your actual payroll schedule. If we don't know how often your employees are paid, we'll have to put it on hold and reach out for that information. So we'll have to get the frequency, and then when is the next pay date? For example, if I know you're paid bi-weekly, that's great, but I need to know which week is a payday week. So we'll need those two pieces of information so we can make the schedule match reality for you. And then for hardships, the biggest thing is just the hardship documentation or the certifications. It's a little bit easier now because I can rely just on the self-certification if your plan allows that, but we frequently have to put it on hold while we wait for that. Okay, cybersecurity, really fast here, we're at the very end. I just wanted to kind of go over, make sure that everybody knows NOVA's commitment to keeping your data secure. We have all kinds of internal policies for all staff that we follow. Everything listed on the screen here should never be sent to NOVA without some kind of encryption. We prefer the secure file exchange that we have with our plan sponsor link, but if not available to you at the exact moment, maybe you can't log in, or I'm not sure what, but just don't email it to us. You can reach out to your account manager and ask for an encrypted email that you can safely reply back to if you absolutely have to attach things in an email. But anything that would have data that would specifically identify a participant, things like a social, date of birth, address, any of that personal identifiable information is what we really want to make sure we protect. So we have some policies at NOVA. Obviously, we have our secure web portal. It's hyperlinked in everybody's email signatures. It's here on the screen for you as well. You can include any files and submit it securely directly to your account manager. We also have NOVA Distributions set up in there. So you can submit distribution requests directly to us that way. You could send it to me, but if I'm out of the office or something, if you send it to NOVA Distributions, it'll go straight to the team. So it won't matter if one of us is out on PTO or anything like that. We do have encryption software, full encryption software. So if for whatever reason we need to do it through email, please make sure that it's an encrypted email that you're attaching things to. We can happily send you one to get it started. We have different policies at NOVA where, like, for example, any new plane contact, they can't just call us and say, hey, I'm the new contact for XYZ company. We will confirm that with a known existing contact for that plan before we just add them to our system. We have mandatory cybersecurity training for all of our employees. We have a specific training to those who go physically into an office, specific training for those remote work, and every single quarter that gets updated. We have a password policy where passwords are updated every 90 days. We have other measures that we go through. We really want to stay on top of any cybersecurity issues that are out there. What we tell our staff is that we treat the participant data exactly like we would want our own data treated. So, you know, it's going to stay secure with us. And with that, we're pretty much at the end here. Just a quick reminder about the CPA credit. Return that evaluation form. You'll get it within an hour, and then you'll get the certification within a week after that via your email. And lastly, do you have any questions?
All right, it doesn't look like we had any questions, so we can go ahead and close out the session. And just like Melissa said, please be sure to stick around for the pop-up survey at the end of this webinar. This will help us track anybody who's going to be needing a certificate. If you do have any questions, you can email us at webinars@nova401k.com, and we can go ahead and forward those over to Melissa and Stephanie if needed. If you want to view any webinars you may have missed, and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you again, Melissa and Stephanie, for your time today. And thanks again to everybody for joining us. We hope you enjoy the rest of your day. Bye.